joining from India. I know it's post dinner and probably a great time to sit and listen into this conversation. For our investors who are in the US, welcome to this first international webinar. This is basically targeted towards investors who are looking at the India market, want to understand a little more depth on the India market. And when we started thinking about this webinar about a month back, I thought that Tom was probably the best person we could talk to because he brings a very good kind of intersection of the US and the India market, bringing in a lot of investing expertise, as well as his very high passion for India. He writes about Bharat and, beyond just, I have known Tom for the last 10 years when he was with Aspada. And, Tom, thank you for taking the time for this conversation. And I'm sure we're going to have some fun conversation here. And we'll also open it up for questions to the audience, right? But before I start, I think it might be great for you to just talk about your background. We don't want to talk about the Goldman Sachs background, of course,
No.
but
No.
but want to talk about why you are probably the best person for our first international webinar.
Oh, the best. Well, I can tell you about myself and you can gauge whether or not I'm the best. But thank you, Shanti and the LVX team for being here. As Shanti mentioned, we've known each other a long time. Our offices are around the corner in Bangalore for many, many years. And she is someone that I think a lot of us in the early stage VC investing ecosystem both know and look up to for lots of reasons, given her depth of relationship and experience. I won't talk about Goldman Sachs, but actually Goldman Sachs was probably the reason I decided to go to India in the first place, having left my role there. About 20 years ago, I was working in San Francisco there, then reading at the time at the recently coined term BRICS,
Yes.
and reading about rising China and India and feeling very naive about the world. I had not stepped foot in Asia, broadly speaking, by then, and I thought I just need to go and see it. I also was very interested in microfinance at the time. And so around 2004, I left my job. I bought a one-way plane ticket to China. I traveled by myself for the next close to 2 years throughout Southeast Asia, China, across the Trans-Siberian Railroad and back. And then I got to India. And I stepped foot in India and I knew something was different. The size, the color, the chaos, the energy. And I rode trains around India, sleeper class trains, for close to a year. Took some meetings in microfinance at the time, but traveled the country extensively and thought this is where I wanted to be, personally as well as professionally. I would later enroll at the Indian School of Business in Hyderabad as a full-time student. And from there, go on to help build a venture capital fund called Aspada, which was based in Bangalore. Eventually, it was rolled up and sold into a bigger group, the LGT Group of Liechtenstein, where it now operates as Light Rock. But that's been the arc of my journey. And so despite having grown up in the US, my professional and personal career has leaned very much toward India for the past close to 20 years.
Now, now that you mentioned India and China, I'm very tempted to talk about the new relationship emerging. But just coming back to the brick definition, Tom, and you talked about brick, and a lot of people talk about the emerging market. Even when I was with HP, we used to talk about the emerging market strategy, and brick would be probably, brick was kind of the focus there, right? But if I were to look at what you call India as a scale-up market rather than an emerging market, right? Would love to talk a little bit more on that.
Sure. Yeah, look, and I think it's very difficult to lump all these countries in under the same brush, right? And so when I think about that, I'm not sure India fits the traditional playbook of volatility, of foreign dependency, of a narrow export-led growth story.
Yes.
It has a very large domestic consumption-driven market. It has a middle class, depending on how you define middle class, as large or not larger than the European Union. there are more people speaking Telugu in Andhra and Telangana than there are people speaking French in France. About this, there are many, many micro markets within it. Um, on the UPI side, right, a concept that's still not well understood in the West because it is so far ahead of
Yes.
Western models, right? I think last month processed 18 billion transactions, right? Significantly more than the US ACH clearing. That's not an emerging market or developing story. Um, you brought up the China story. I think it is a very different story. I mean, China scaled largely through manufacturing exports.
Yes.
India scaled largely through services, through consumption, and increasingly now global supply chain integration. And so, viewing India only through this emerging lens, I think greatly underestimates just how large and self-sustaining the country already is.
Yeah. So I think, Tom, I think the way when I listen to you, and because I'm sitting in the Indian market, I'm able to understand the nuances beyond the conversation, right? But for investors who are here and who are trying to understand the India market a little better and why they should probably allocate some of their private market investing dollars to the Indian market, right? And we had this very interesting conversation last week where you said you met a macro investor. And, when you had that conversation, it was about, probably today is the right time to invest, but you think that they thought a decade back was not the right time to invest because the macros did not kind of tell the same story as what the micros tell us, right? So
Mhm.
can we kind of go a little bit deeper and probably talk about, one or two maybe micro trends and, what has been your learning as you've been investing in India, right? Because we have a lot of also people who are very skeptical about the Indian market, right? So just to allay all of those fears and, just to kind of answer some of those questions for our investors, I would love to go a little bit, maybe one level deeper into that micro story.
Sure. Well, obviously the big macro number is India's 6 to 7% GDP growth, right? Compared to roughly 2% globally. And that, is a sustained number that doesn't look like it's going anywhere, right? And so that has woken up a lot of the big macro.
Yes.
If you kind of look at now, why India now versus several years ago, let me actually go back to 2010 when I was a
Yes.
student at ISB, right? And
Yeah.
maybe we can break this into a few different phases, right? And
Yes.
these are not catch-alls, and please chime in, right? I'd say, let's say 2010 to 2015 in the investing space, we'll kind of call that the Flipkart era, right? E-commerce boom. You had a lot of Western model clones, the this of that analogy. But you had infrastructure being built, John Don coming along in 2014, much more inclusive type growth initiatives, right? I'd say there was a phase two, 2016 to 2019. Let's call it the geo shockwave, right?
Absolutely.
Data prices crashed. Um, 300 million new internet users overnight. Bharat came online, right? Which
Yes.
opened the opportunity for new kinds of delivery of goods and services and business models that simply were not possible even 4 or 5 years ago, right?
Absolutely.
And um, that's everything from banking to financial services to telehealth, right? New models started to come into place. You had this period of in the pandemic, 2020 to 2023, this acceleration, right? Where almost every sector digitized in some ways, but it was still early. Funding, and you'll have the data, probably peaked. Valuations got a little bit frothy. And that brings us to now, where, and again, you can opine, we may be in reset mode, leaner startups, smarter capital, export focused platforms to go along with the consumption story domestically. Um, but so much has enabled this to come, right? So let's just look at manufacturing, right? Apple exported $15 billion worth of iPhones in 2024, right? Unheard of. The infrastructure, not just digital with, Geo and UPI, but physical infrastructure. I think India has built more kilometers of roadways in the past 5 years than it had from independence until, 5 years ago, right? Um,
Yes.
right? So that, physical infrastructure, airports in tier two, three cities, roadways, ports, logistics, coupled with a domestic consumption consumer class and the digital roadways, which are as more sophisticated than anywhere else in the world, arguably, I think make now an extraordinary time
Yes.
to be looking at India. But please, go ahead.
Yeah, just to add to this, when you talk about that geo shockwave and just that uh, a lot more number of people accessing data today, I think the very interesting observation which we have seen, which actually happened through an initiative called Digital Desh, right? Which one of our friends is running, and they actually go to each of the states. They kind of go to all the tier two, tier three, tier four cities there. What they've noticed is that because of access to data, the almost consumption behaviors are very similar, right? Probably my ability to spend is lower, but and it is a value TAM, right? So if I were to divide India 1 and India 2, India 1 is the prime TAM where basically people are willing to spend a lot more, while India 2, which is basically below that $10,000 income, but access to data is actually value TAM, right? So they are a lot more value conscious. So when now we are seeing founders building for that larger market of India too, we're also seeing how can they increase their margin profiles, how can they increase better efficiency so that you're able to build more businesses which have become more valuable, right? So that is the shift we are seeing even in the founder side of the story. And I don't know what you are seeing, Tom, but I would love to hear from you what you're seeing in terms of the shift in founder profiles when you are now seeing this new post COVID, post the downturn, right? The founders coming up now is very, very different from at least what I saw in 2013, 2014, right? At that point of time, entrepreneurship was still very new, right? Businesses had not scaled and there was not much exits. But today, a lot of the generation of founders coming in have actually worked in some of those scaled companies. So they
Yep.
understand how to build businesses in India. They understand how to navigate regulation. They understand how to navigate policy. They understand a lot more deeper in what it takes to be a startup and build a business in India. And the second generation of entrepreneurs we are seeing who are actually CXOs of these large organizations, founders who've taken exits, who've also seen other founders make money, employees who have made money because of ESOP, right? So I think it is kind of coming to a lot more mature cycle today in the Indian ecosystem.
I agree. And I can speak only, to let's say the past 15, 20 years, but I graduated from ISB in 2010. When I
Yes.
graduated in that batch, there were probably six, seven, people, that decided to go start their own businesses. Now, there's lots of reasons for it, right? They have school loans, um,
Yes.
but that has changed dramatically now, right? I mean, if you look at the graduating batches, not only of ISB, but of other schools as well, people are starting things, right? People are taking on new challenges. And so, I'll call this maybe the Shark Tank effect, right? Which is now you have families, right, sitting around watching Shark Tank. Entrepreneurship going from something that viewed with skepticism to actually having proof points, where actually, as you rightly said, there are founders now who have exited. Some of these very large companies have provided terrific training ground for people to go out and start things. Availability of early stage capital is significantly increased. I think there's
Yes.
probably more risk-taking mentality with regard to that capital as well, right?
Yes.
And so, and you're right, Indian founders, I think, also are probably uniquely positioned relative to internationally, right? They have had to build traditionally in more resource constrained environments, um, low trust with consumers, patchy infrastructure, knowing that, every price accounts, right? And that actually breeds all kinds of, innovation that I think is specific to India. If you think of Flipkart using cash on delivery, right? It's a great
So,
example, right? Unlocking e-commerce, right, in a way that actually fits India.
yeah.
Um, um, so there's lots that I think that has been primed in the past 15 years now, and you have an entire class of entrepreneurs, and you can feel it, right?
Yes.
It is palpable. Um,
Yes.
and you see more and more entrepreneurs actually, and this is very different. We did a lot of investing in agricultural supply chains, logistics, these asset heavier kinds of spaces where often, the entrepreneurs were older. They had come out of a heavy duty cold chain business, um, or some sort of a Reliance retail, something. Now you have young teams actually trying to take on these challenges. Now these are still complex markets, but
Yes.
you see young people doing things across the spectrum, right?
Yeah.
Not in just one or two spaces, not just in SaaS for export, but actually building for Bharat, right? And I think that is a remarkable change that I've seen.
Yeah. Yeah. Actually, very, very interesting you bring this up because I would love to also hear what is the difference in profile you're seeing between founders in India and founders in the US. Because I want to talk a little bit more about how the market in India sometimes is very different from any other market globally. So, for investors trying to find a similar business model in the US or similar company which has worked probably in China or US, you are going to actually miss some of the best founders and best contrarian ideas coming up from the India market, right? And that's what at least I have seen, that some of our best founders are very, very first principle thinking, very grounded. They understand the depth of the Indian market, and they're trying to build something very, very unique to the Indian market, right? And some of them get very frustrated when you try to say that, this didn't work in US, or probably this is how it worked in China, and then this is not how it's going to work in India, right? I think as an investor looking at the India market, what would be your kind of recommendation on how should you evaluate transactions for the Indian market?
And again, it India, despite being, 15% of the world's population, in some ways is the greatest secret hiding in plain sight. And what I mean by that is, I'm sure Shanti, when you do your trips to the US, it continues to be poorly understood, right? The dynamism and
Yes.
what is happening. Again, talking about explaining the UPI or ONDC, Jandan, Geo, the whole India stack to people that are not familiar with it, it doesn't register because um, the West has followed a much more linear model, and India truly has, on some of these fronts, leapfrogged in many
Yes.
respects, right? Even the idea of, you look at data consumption, you have the world's highest data consumption on a per capita basis, because it just leapfrogged the computer, right? And people use the
Yeah.
phone in ways that they do very differently in the West. Um, in the West doesn't really understand WhatsApp,
Yeah.
right? Right. And just the enormous social plus business and the transactions that flow over it. And so, I think the first mistake is probably, again, back to this China export-led top-down central planning, right?
Yes.
Which is not the Indian way. I think the other is that people generally tend to look for the Silicon Valley quick wins, right?
Yes.
Which are
Yes.
very few and far in between. India, in my experience, things take longer, right? Things can take some more capital, but that doesn't, but also, the next generation of great India Inc. businesses, when you think about India Inc. 1.0, those
Yeah.
businesses weren't necessarily built in a 5 or 7 year time frame. They have been
Absolutely.
built, they have been built generationally into very large businesses, right?
Yes.
And so there's this mismatch in expectation. Um, I think the other big mistake too is often in the West, people think of the word informality as something that needs to be fixed, right? Or something that is broken, right?
Yes.
Um, and I think it is a lack of appreciation for India's operating system, right?
Yes.
Which really is its own. If you say China and the U and the West or India, it's the third way, right? It is its own system. Um, And, looking for those models that are easily recognizable through pattern recognition to the West, I think misses all the dynamism of
Yes,
India's
I
formal
agree.
economy and how things work, right? Which accounts for the majority of the country.
Yeah,
When we talk about India One, as you mentioned earlier, right? Um, let's say that is 100 million people, right? Now, it's a deeply consumptive class and it is large, right?
yes,
And it has significant paying power, but it is 100 million people on a denominator of 1.4 billion. And so there's tremendous activity occurring in the in the peripheries, right?
yeah,
And that those tend to get missed oftentimes because it's hard for people to make the jump of the this and that. Um, and so, between the time horizons, between not having something to latch onto, between this third way model, which I think, needs to be told to the world and people need to understand and appreciate it. There's lots of reasons why, investors get it wrong or just don't have the ability to diligence and actually take the time to want to dive in, right? It can be easier just to go elsewhere.
yeah. So this almost warrants like a maybe like a deeper, like a 1 day discussion, Tom, right? So
Yeah,
hard to
sure,
encapsulate everything like in a 30-minute
sure.
conversation. But just like the key takeaway is that you have to have a little bit of a different lens when you're looking at companies in the Indian market. And I think that's something which our team tries very hard to do, right? So Pranav, who will actually be the next speaker after this, he has worked for 19 years in the capital markets and then moved to private markets. So right, so really seen how public markets behave, and then how do we now look at private markets behaving. And somewhere I think there is a similarity if in how you would look, because a business is finally a business, right? Whether it is funded with public money or whether it is funded with VC money, somewhere there is still a similarity there. But I want to also, just to ensure that our audience is not gone to sleep, we are just going to do a quick poll, like a just like a 10 seconds to answer. I think Divyansh will pull up the poll, and then we'll continue on the conversation. I want to talk about sectors, and just I think no conversation is complete without a mention and reference to AI. So we will come to that after the poll. So Divyansh, you want to pull this up?
Yes, it's on the screen.
Okay.
We are seeing some good responses here. Let's see
Okay.
what people think. What you think of India as an investment destination? What comes to the mind first? So most of the people have said that it's a large consumer market,
Awesome.
and second one is rapid economic growth.
Great.
Yeah, these are the top two.
So Tom would love to kind of just quickly probably
Yeah,
get you. I also agree. I think the consumption story of India is what is going to drive a lot of growth. And in fact, I'm also part of a fund called Samved, where our thesis is actually we are saying that we want to invest into that part of India where we want to invest into companies which are building productivity gains and improving productivity of India too, because we feel with that increase in productivity, you will see people have a little more time. And with that time, they probably will build secondary income. And that is what will propel the economic flywheel of the country. And with that increased economic flywheel, you're going to see an increased consumption story, right? So it is all kind of all falls into one cycle. But Tom, if there's something more you want to add to that poll, but
The
yeah,
poll, yeah. Well, I'm not allowed to select all of the above, unfortunately. So
yes. Um, so just moving on to the next topic on sectors, right? Where do you see the next 5 years, just investment sectors, and where do you see AI play a role? So I have to bring this up here. I had a very interesting conversation with a VC, and I was telling him that, are you investing in AI? And this was almost like 1.5 years back. And the response I got was really, it was very thought provoking, because he said, if you look at the last 3 to 4 decades, right, probably the biggest inflection, biggest change or disruption in technology we have seen is when the internet happened, right? When actually life changed and the world became more connected. So that was one wave of innovation, disruption, technology. The second wave was the social wave, right? Where we actually saw behaviors change because we saw how people actually started interacting with each other very, very differently. And this is probably the last big disruption wave we will see in our lifetime of investing, right? Probably this is going to last for the next 2 decades, right? In terms of how AI is going to so rapidly change how we work. And we are fortunately, as the investment community, sitting at that forefront of that disruption. So not saying I won't invest in AI because AI is changing too rapidly, I think may not be probably the right strategy, because you have to go invest to learn. And this is exactly what angel investing or investing is about, where you invest because it is a high risk, but of course your returns will be way higher. But AI falls in that category, right? Where it is going to be a kind of a life-changing technology, life-changing moment for all of us. Because when we look back, we'll suddenly realize that what we did 5 years back seemed so archaic from what we are going to do today.
That's right. That's right. I think that's absolutely right. And specific to AI investing, I think you may be better suited to answer the questions that often come up. I'm sure, when is India going to have its DeepSeek moment, right? For instance.
Yes.
And whether or not that's even relevant, since, so much of the AI progress coming out of the West Coast in the US is Indian engineering talent anyway, right? So, but without a doubt, India may be the world's largest test bed for AI implementation, right? As you
Yes.
rightly said, across multiple sectors, that
Yes.
I think is going to have that shockwave effect the way Geo did when, with data price, crashing almost to nothing and changing how new models work, right? I mean, when I think about, again, we did a lot of investing in agricultural supply chains and logistics, small whole farmer productivity enhancement, right? The ability now to integrate crop science, weather, data. I think back to the early days when I was a student going and visiting an e-Chopal at an ITC center, right? And you think of how far things have come since then, right? To
Yes.
be able to integrate in real time how a farmer should be treating a crop or a sick buffalo, right? I mean, these are things that just not were possible. When you think about financial services, right? The physical onboarding through DSA networks, through KYC, right, which has dropped, to hours as opposed to days, can condense even further, right?
Yes.
And there are uniquely Indian ways that these have been approached in the past. If you look at the arc even of microfinance, right? Joint liability group lending, for instance, not something the West would understand, right?
Yeah.
How to build these kinds of trust mechanisms. And I think you will continue to see AI push these models even further in uniquely Indian ways.
Yeah.
Telehealth, education, we can go on, but I think without a doubt, almost everything, that every business model is probably ripe for some sort of, if not disruption, augmentation,
Yeah.
the way they operate.
Yeah, so I think what we miss in the fundamental layer of AI, what you said, will India have its deep seek moment? I think that is a function of capital, right? Like how much capital can you actually invest? And there I think we have a disadvantage as a country, right? Because we are not investing as much as what other countries are investing. But you never know, you might be surprised because somebody might just come up with that low cost solution which could actually kind of defy all the high cost solutions which are happening today. But we are yet to see that, right? But from an AI perspective, what I have started to see is, I think as a founder and as a company, if you're not adopting AI, I think there is a problem. You
I
have
think
to adopt it, because otherwise your cost is going to go out of control, because every other company is today actually adopting AI. So adoption of AI is very high. I think and I'm also seeing some very, very good companies which have a lot of patents, right? I'm currently also working with a company who's actually reverse building the knowledge graph to ontology, and that's the patent they hold there, right? So really kind of going where nobody has gone today globally, right? So today everybody says if you want to kind of crunch data into your AI engines, you need to build your ontology, then you build your knowledge graph. This company is saying, I will use the data to backward build your ontology, right? So I think there is innovation happening. Again, India is so vast, so diverse that we have to be very, very alert to these innovations happening, and hopefully we can bring all of that to the platform for the investors to look at, right? So even if you don't invest, it's great to also listen into these founders, because there is so much innovation happening in terms of how people are rethinking about how systems are getting deployed. But as we are coming to the end of our time, and I don't know how much more time we have, Divyansh, but I would love to open it up for questions. I think I'm sure a lot of our
Yeah, yeah,
members have
yeah,
questions. I would love them. I would love Tom to take those questions.
yeah, yeah.
Divyansh, if you can help us with this.
Yes. So, Tom, the first question that I have for you is, uh, given the India's unique challenges and basically four pillar of challenges: infrastructure, three pillars: regulatory, income distribution. Which sectors do you believe can generate asymmetric returns in a 5-year period and 10-year period, in your opinion?
So infra, regulatory, and income distribution, right?
Yeah.
Yeah. So again, we kind of need to look at India across multiple segments, right? We'll go back to the India one discussion. If you're thinking about 5-year, right, I think focusing on that segment, which is a largely urban consumer class that has paying power not dissimilar from those in the West, there's a lot that can be built on the brand side, right? And I think it's brands not only domestically in India, but I think we're going to start to see brands for export. I think India has probably not done a great job of owning the narrative in a lot of things that it has brought through home, and you see that everywhere from going to a yoga studio in the U.S. or Haldi. For some reason the turmeric narrative got away from India, and it's everywhere in the U.S. But I think there are Desi-focused brands. Tanishq now has showrooms in the U.S. Amul actually has a business now. They partnered with in Michigan and doing heavy cream. But there's so much more that I think India can build and bring to the world, right? And so I think if you're kind of looking very short run, consumer focused, consumer class kinds of businesses, right? If you go beyond that to where I have actually been an investor for much of my career, it actually was not focused on that. It was actually, I'd say, more focused on the peri-urban, because a metro consumer is not the small as a same town peri-urban consumer, where there is regulatory nuance, where those networks matter a lot. But there are ways through business model innovation to touch that group. I mean, you don't need to go so far as uniquely Indian models like sachetization, right? Which allowed, this, and you see the sachetization of things like insurance or finance or actually goods, but actually getting into that market, right? And I think there's a tremendous amount of opportunity in that market, and Shanti chime in, that is actually not captured in the formal economic data, because a
Yeah.
lot of it operates in cash, despite GST, right?
Yes.
And it continues to operate in cash. And in fact, on that note, there's actually more cash in the system right now than there is before Demon, right?
Yes.
Right. And so, actually getting into those networks, I think there's tremendous opportunity there to build, again, basic infrastructure, health, education, agri supply chain, and new kinds of lending models.
Actually, it's very
Great.
interesting you talked about the soft power, Tom, because one of the things I think the narrative which has started to emerge in India is India does not own its soft power very well, right? And the reason why the West influences so much, and the reason why we read Washington Post and nobody in the US reads maybe Economic Times, right, is because I think we still don't own the soft power which we should own. And that I think is required for us to globally change this narrative. That's a very interesting point. But Pranav, do you want to add something here? Because Pranav, like I was introducing, he is actually heads our investments, does sourcing, talks to all the founders who come to the platform. So I would love to hear Pranav's view on this question.
Actually, Shanti, one thing that really caught my ear was quick Silicon Valley gain, right? We don't see that in India. We don't see companies becoming unicorns and 5-10x size in 1 or 2 years. And that today, the 100 of them, most of them are consumer facing today. So I think that is a step by step. Yes, though Indians are making technology globally, I think that's what even Thomas was saying, that the question is whether we really need to create that D2C moment for us, or we're just quite okay just using, and the world can build for us and we can use it.
It's very true on this narrative. I have traveled with some of the iSpirit delegations occasionally when they come to the U.S. and to me, the UPI, and as you know, there are folks who we know commonly are kind of taking the story to the world, but not in enough scale to even because it is such a big story, right?
Yes.
And I think so foundational. And of course, there are countries in the world adapting bits and pieces of it, but I would love to see India really own the narrative,
Yes.
and be proud of what it has built and put forth, because the infrastructure is simply world-class and unique,
Yes.
and not well represented.
I completely agree with that. Yeah. Divyansh, you want to go to the next question?
Yes, Shanti, and I would love to hear it jointly from Tom as well as Pranav. The question says that beyond the model itself, what operational metric are more critical for assessing the early stage AI venture, especially in healthcare sector?
To evaluate an AI venture in the healthcare sector,
In the healthcare sector,
what are the
what are the most critical metric beyond operational metric?
So can I just take that, and then maybe both of you can take that, because I've been talking to a lot of AI founders. I think when we say that AI applying to a particular sector, I think the basic fundamental business metric doesn't change, right? Because AI is just accelerating the value and probably creating better margins or creating better moat there, unless it's a foundational LLM you're building for the healthcare sector, right? I think if you're just talking about AI in the healthcare space, I think the metrics will continue to be the same if it were not even AI, right? You will continue to look at customer love. Is there value to what you're building? Does somebody actually want to buy this product? Will somebody pay to use this product? I think all of those questions remains the same. But Pranav and Tom, over to you on this.
Pranav, go ahead.
Okay, so I think I'll start with a small story. In the US in 1930, there were 3,000 car manufacturers, 3 survived. Right? I think this is what will happen with the AI. So if you just break it down to the people who are making the AI tools, they will keep perishing at a very, very fast rate because technological disruption is happening at a very fast pace. So the breakout we are seeing is companies who are creating platforms which can plug in other AI tools. So if you're able to do that, and I think the companies we are talking to have very interesting marketing matrix. So if for dollar return on the AI is a very high ROI. If you don't have a high ROI, if you're not able to pay back in 6 months, 1 year, the company is not worth it, because we can't see 3 years into the future with AI, because AI will also look very differently. Like Perplexity 6 months back, Shanti, was like we were wondering what's happening, and today Perplexity is everywhere.
Yes.
It's just at a very, very fast pace. Thomas, would love to hear what you're
On the I think you've covered it pretty well. And quite frankly, on the implementation side, perhaps I can talk about some of these sectors, but on the AI investing itself, I'll leave it to you.
So in that case, Thomas, there is one question which has been asked here like 2 times. that we spoke about sectors in India, but generally the world sees that the things are divided into product and service to much extent even today. So coming from an India perspective, where do you see more innovation in the next 5 years, whether it is going to be service sector or whether it's going to be the product sector?
Yeah, that's an interesting question. It's actually one I spent some time thinking about because I am helping build a company right now that is very much playing to the momentums built in um, product export from India, right? I think if you look, let's go back to even before what we call the Flipkart era, you had the real generational businesses, um, Infosys, and so forth, that were exporting services, right? Now, obviously, that continues to be an enormous part of GDP. It does not employ that many people, relatively speaking. I think there's some real questions there which haven't been brought up, which I'm not especially qualified of what actually AI brings into the BPO space and the services-led economy, and whether or not AI is an enabler or there's some risk to India's GDP as a result. But I do see now India moving towards more of an export powerhouse. Relative to China, it's about a tenth of China's global exports. It is set to double manufacturing exports to about $1 trillion in the next couple of years. And so I think more and more as manufacturing catches up, it will continue to be much more important part of GDP than services alone. Pranav, if you have a view there.
Yeah, actually, if you go back to auto ancillary, and we have some of the best auto ancillary giants in the world today, and that revolution happened 20 years back when Maruti came to India and what Maruti Suzuki became and what we're looking at today. A similar thing will happen in India, where global technology will come to India, they will get India partners. And surprisingly, a lot of startups will get global technology to India. I think that is our era where not the big boys only, the smaller boys, the startup boys out of Bangalore and Gurgaon will bring the technology to India. But we will start building for the world also because there is an ecosystem which is coming around. Like if you just look at a Zomato, if you just look at a Swiggy, they have created an infinite ecosystem which keeps revolving around the QSR space. A similar ecosystem is getting built around us. So the infra is coming, the government is supportive. We have very low cost of debt, what is there. And we have a lot of countries who want stuff from India today. So we will see a massive era of technological transfer to India. Like, the iPhones getting built in India itself, obviously they have transferred technology to the Tatas. They have not built it by themselves. So I think that's an era which we'll see. We'll see mainstream startup companies also start adopting global technology.
Thanks, Pranav. Shanti, I have one question from
the way I look at this product and services is, I think, especially in the AI space, AI is going to be AI plus assisted services, right? AI is not going to be only product, not going to be only service. It is going to be, you have to differentiate with your product, but you have to offer customization and services. It's like one of the startups I work with, they call themselves the Palantir for India, where they are saying that I will offer product plus services. And that is how we are going to see that kind of grow in India today. Yeah, Divyansh, you had some question?
Yeah, one more interesting question has come up for Tom. So, it is about how do you really distinguish a truly powerful, sustained macro trend from a short-lived thematic bubble that angel should avoid?
Well, I mean, how do you distinguish a long-term trend from a short-term bubble? That's the question.
Correct. Especially from the prism of an angel investor, how do they avoid over or under evaluating that opportunity?
So I would look at, and again, if we think about the size of the domestic Indian consumer, for instance, right? Which is large, which again, depending on where you focus, is incredibly deep. India does have a large homegrown market. It is the #1 producer, for instance, of almost anything you can think of, right? Every fruit and vegetable, grain, it trades off with China, right? So there is a large embedded market. And so if you actually look at foundational type sectors, right? Agricultural supply chains, healthcare, education, and then play on the fringes of saying, well, these are probably not going away, right? But what is the business model innovation that will let them operate more efficiently, right? Or reach new customers? I think that is where you should look, right? Whether if you want to avoid the hype cycle, I'm not smart enough to know whether the next crypto investment or this AI agentic agent is the one to take a bet on. Rather, what I have done over my career in India is actually look at, what we call essential services, kind of more nuts and bolts, and actually look at how does good business model innovation help this company reach a new customer or do what they're doing better, right? And build out the unit economics further. So it's really investing in the kind of the underlying big theme, which is supported. It could be supported by export, but also supported by a consumer that has already demonstrated the propensity to pay for that good or service. Pranav, it's a good question for you.
Actually, I have an example in mind. If you look at the credit space, so India is starved for credit forever, right? But if you look at, so that's a macro theme, credit. So you know that loans are going to be there, banks are going to be there, NBFCs are going to be there. But 2 years back, we saw buy now, pay later craze, right? People are running behind you to give money. So that's a micro trend in a macro theme. So if you look at those business models, they're operating at a 30% NIM, and the net interest was 1% because they had a lot of losses. So at Let's Venture, actually, Shanti, we did no investment in buy now. We didn't lose any money for anybody there.
Yes.
We realized that the macro trend remained, but the macro trend was not aligned to the original business thesis. So we just dug that. But we obviously funded some NBFCs, some gold loan companies. We did that, which are more safer models, underlining a overarching macro theme.
Yeah. Just to keep the interest of time, Divyansh, do you want to let Pranav do the next session and maybe we can come back for questions, or maybe people can email questions and we can probably do another follow on.
Yes, absolutely. We can do that.
Actually, before we let Thomas go, Thomas, I think the blue color kurta is looking very nice.
That's what I told Tom, that you're actually dressed for the Indian webinar. And this is what he bought in Bangalore, he tells us.
Well, yeah, 90% of the clothing I own now is from India anyway, so it's but thank you.
Wonderful.
This is like Manyavar types, the consumer brand. No, thank you, Tom. Thank you so much. Yeah, and I think it's been great chatting with you, and I think the questions have been amazing. I also want to just thank our investors who joined in. I think I really thought some of the questions were very, very interesting and very, very, very good. So thank you for engaging with us.
Appreciate it. Thank you so much.
Thank you.
Thank you, guys. Thanks so much, Shanti.
Thank you, Tom.
Yeah. So Pranav, you want to take the next?
Yes. So you guys are left with me now. So good morning to the investors joining in from the US, and good evening for our Asia investors. And thank you, Shanti and Thomas, for helping me to create a ground so that I can pick this up from here. I would like to start with a quick introduction to Let's Venture. Shanti started the organization 12 years back. Today we are an institution by one of the largest angel platforms in the country. And I'll just quickly take you through some of the numbers. So we have over 900 funded companies today. We probably are 1 out of 3 angel investing in the country is done by Let's Venture as we speak today. The portfolio value is around $230 million. We have put $120 million in both companies, Series B plus sort of companies, and we have around 5,500 investors, participating on our platform today. Over 100 syndicate partners, because if you look at the journey of how angel investing started, it was an old boys club. Shanti came in, brought in Let's Venture, brought in the technology which probably could allow you to invest from anywhere in the world. Then came the AIF regulation, and today Let's Venture is the largest angel AIF in the country today. I think, and that's the size which we're talking of. We have investors from across 50 countries who have organically come to us. We have never spent any money to go out and acquire any investor. I think that's the confidence. Everything is happening remotely. You can sit in New York and invest, and you can sit in Bombay and do the same. Moving on, I think what we never bring out this data, but we have the largest data pool of knowledge today in the country. We have pitch decks of over 35,000 companies with us, in registration over 14,000 investors who have probably circulated over a period of time with us. 350 domestic and global family offices are working with us as we speak. They continuously keep evaluating deals across stages, across sectors with us. And we work with around 150 odd VCs and 450 odd ultra Asian. I think this number is very critical in the backdrop of India, because if you're tracking the listed markets, if you see in India, FIs have been sellers for the last 2 years consecutively. And what has really changed is the Indian retail investors have gone out and really held on to the Nifty, held on to the markets. And I think what's also important is the diversification of what's going to happen. We will see a similar trend happening over the next coming decade to what's happening with India and the angel investing in India. I think we are at the apex point of that. And I think from there, using technology, using diversification, I think the trends are going to change for us. So who are you? Who's backing us? And it's very interesting. We are obviously backed by Axel Partners and Chirate. But it's very funny, in one single round, the three largest tech giants, Infosys, Wipro, and TCS founders have invested with us in one single round. So Shanti was able to get in three biggies into one room and help us to back this. Obviously, we have Sharat Sharma, Mohan, Gopal Srinivasan, Rajan Anand, obviously, Rashad Premji. So I think these are the guys who sit on our cap table. So obviously, I think the level of diligence, the level of integrity, board ethics, principles is completely defined from these people who are there. And Shanti has stirred us all the way for 12 years now. The question is, what are we offering? So we have largely 4 offerings today. LVX Start, which is the largest angel platform in the country. You can invest a small amount as 5 lakhs and go up to a few crores. That should not be a problem. 2 is the LVX Grow, which is the large family office platform. 350 family offices actively work with us. These are also some of the largest LP investors in the country as we speak. Because we are sitting on 900 odd cap tables, it's obvious for us to work with around 150 VC funds. So because of which we started an investment banking practice for pre-series A, Series A, Series B companies. And with a lot of investor requests, especially for investors sitting outside the country, I think who probably are not able to track India, who don't have enough bandwidth, who are probably preoccupied with what you're doing. So we're going to launch the Photon X fund, and this is the first time Shanti and me are going to talk about the fund on this aspect. So what are the core principles? I think one important subject which Thomas got in was the Silicon Valley quick gains. It's not going to go crazy in India. So it's going to take time. Some companies will really break out. Others will take an organic time to really grow up in the value chain. For us, diversification is very, very critical. I think we are not saying put all your money in one bet and let's see what's going to happen. We have a portfolio-based approach to how we are looking at investing. Number 2 is liquidity. Today, the top management of LVX spends more than 50% of their time in liquidating the portfolio companies, selling them to the right owners, selling them a new set of investors, maximizing investor value, because it's not that you buy it and you hold forever. We don't believe in that strategy. At every stage, we have to keep trimming the portfolio, keep taking the money home. It's also important to see where the macro trends are. If the overall market scenario is good, hold on to it, do nothing about it. If you see that market scenarios are going to turn bad or they're already in a bearish phase, if you're getting money on the table, please take the money off. So I think that's the hallmark of what Let's Venture has been doing today. I think the risk and return balance is very critical for us. That's the reason we are going for multiple sectors and multiple stages. Because in every sector, I'll give a simple example. If you look at any consumer brand today, at the seed level, all consumer brands look the same. The real breakout starts happening at a pre-series A, series A level. So typically, all consumer brands, when we are entering, are typically at pre-series A, series A levels. So I think even for fintech companies, if you're building a fintech infrastructure company, we will come in at an early stage. But if you're building a Me Too sort of a business, obviously which has some moats, we will wait for 1 or 2 rounds for us to start jumping in to come in. So I think that's the differentiation of when do we come in, and not only thinking of the X's which will come along with it, but I think it's important to really go out, and go out and pick the companies at the right time. I think what's very critical and what we understand very deeply is that price and the entry time is the only thing which we really have in our hand. After that, it's all the founder, the macro, the other investors play in. And we cannot perfect it. We can't time it, but we can at least come in at a striking distance. I think that's what we keep trying to do. Obviously, and Shanti has been really pushing the AI part of it. So most of our transactions, most of our study what's happening, we are using a lot of AI in our system today, which is improving the knowledge of how we're evaluating deals. Because humanly, it's not possible to do 50, 60, 70 transactions in a year. So we're continuously evaluating multiple tools, and we're using multiple tools to make sure that the way we're picking up companies, the way we're evaluating sectors, the way we're perfecting our entry pricing is based on a large amount of data, which might not humanly be possible. All the deal at Let's Venture today are either backed by a large VC or a large family office. So I think we are co-investing with some of the finest minds in the country at this point of time. Moving on, because we talk to some of the best minds in the country in the investing space, I think this is something which we wanted to share our learnings from some of the largest family offices we are looking at. The key difference we are finding today is investors call themselves as asset allocators and not investors. They are not saying I want 20%, 13%. No, I don't think they're talking about. Capital protection is paramount. So when you look at this, we are saying that public equities is typically 30-40%. And this is also diversified between India and the world. Today, Indian investors are able to invest in the world, and world investors are able to invest in India. So I think that's something which we can really copy. The very conservative ones are now coming up the value curve and saying, okay, let's do some investing into the early stage part of the business. So if you look at private equity, VC is typically 20 to 40%. And you will break this down further, how you can go out and invest further. Real estate, they have a house, they have a factory, they have offices, which pays holiday homes for them. Fixed income is 10 to 15% because this is just like a defensive, as good as cash. I think that's what they're looking at. They have some alternatives, and alternative is something which is probably not fully developed in the country, but globally it's a very, very big asset class, which is coming up. And I think we will see a lot of capital allocation which is going there. And they usually with 5-7% of cash, which they can go out and use. So I think the focus discussion today is the private equity and the VC part, and we'll probably share how are some of the finest minds looking at this. So we have also structured our business around this as a thought process, right? So today we are offering direct cap table deals. They can go directly onto the cap table if you're writing a certain size of check. We are then going through the AIF route, the Let's Venture AIF route, where you can co-invest with other smaller investors and get onto a larger cap table. 3, we are coming up with a fund which is helping you to do. And we're offering select secondary and pre-IPO opportunities for late-stage investing, right? So if you look at the allocation, direct startups typically have deals or ideas which are very close to your work, subjects which you really understand, or somebody in your family or you are doing it, where your conviction level is the highest. And when we're getting those ideas to you, this is where you go out and really maximize yourself. So you go directly onto the cap table. There is no carry. There's a small fee element to it. And I think that helps you to go and maximize your knowledge and maximize your return at that point of time. Moving on, investors have come back to us on the fund. I'll skip this part today. I'll capture it later as we talk. Coming to the angel AI. So typically, we are telling people that they should do 30-35% of angel investing out of the total pool. And the reason we say that is, one, you have a very wide offering, around 50-60 transactions in a year, which you're seeing. All of them are backed by VCs, all of them are backed by large family offices. Your risk perception is very, very less. So you can build a 10, 15, 20 company portfolio. And whenever you see a breakout happening, and whenever you get a preemptive, we have a preemptive right in most of our companies, you can go back and double down. If you want a larger check in that subsequent rounds, we can even facilitate it there. That you can directly go onto the cap table with a larger check. So I think that's the relationship we share with most of our founders. Secondaries and pre-IPOs, this is a little bit seasonal, because what's happening in the stock market is, whenever we see certain companies who are 1 year, 2 years away from an IPO, and that's an interesting time for us to come in, because they're not pure pre-IPO, the price is not set. But there's a clear path over the next 12, 18 months for companies to go IPO. So I think people who want near-term liquidity in the next 24 months, 36 months, this is the best mechanism for you to come in. I have broken down from a return expectation and also companies which we have worked in, how they have worked out. So direct deals, 25%, 8 to 10 year investment horizons, you can hit the ball out of the park over here, right? Because you don't have carry, you're going directly on cap table. But I think this should be very measured, because I think it's very important for us to really work on. Devansh will take the questions probably a little later, just so that I can cover everything and we'll pick it up. VC fund, I'll take you through that. Angel investing, 4 to 6 year, we are focusing on, some of our companies have given us 60-70x also returns. Some of them have given us 2-3x return. But I think this is also construction of a portfolio within a portfolio. So you're completely hedged. You're, a lot of questions have come on AI, right? If overall the sector is blooming and we really don't know what's going to happen over the next few years, it's important to take smaller AI bets. I think the AIF actually gives you the safest and cleanest opportunity to be a partner of it. Because what also happens is, when you're part of larger cap tables, the information is a problem, data is a problem, decision making is a problem. But I think when you're part of an AIF, as an institution, we're able to probably command far more knowledge and far more information and rights compared to what an individual investor would do. And secondaries and pre-IPOs, exit is 2 to 4 years, depending on if there's a delay in the IPO. Typically 24 months to 36 months is what we're looking at. And it might, sometimes companies do go public and they really have a good opening at that point of time. So I think obviously market dynamics will play in. We are quite selective and careful when we're bringing up these opportunities, because we ourselves want to be very sure. IC needs to clear it just to make sure that we are able to bring out these opportunities to you guys. These are some of the largest family office: the Bourbon family office, Lion Rock, Value Quest, Urmain, Haldirams, Enam, Patnis of the world, Mystery Ventures of the world. They're active investors with us. Some of the best public sector investors, or sorry, the private sector investors, which are there with us today, or say Rakesh Jindwala's family, Ashish Kacholia, Mukul Agarwal, Enam. All of these investors actively work with us. They have done transactions with us in the past. I will pause here if you guys have any questions. Divyansh, you want to add?
Yeah, Pranav. We can take a couple of questions right now.
Sure.
First thing is, what role does LVX play in price discovery of pre-IPO companies?
Okay. So I think pre-IPO is very interesting, because there are 2 stages. One is the IPO price. Then the pre-IPO is when the price discovery is just happening very close to the IPO. What we are focusing is sort of a pre-IPO, and I've spent most of my life on the public market side, and I think what is very interesting to see is that as the companies go IPO, they typically have some of the lowest multiples what they would have got compared to what a VC or a private equity guy would have given you. So I think we definitely look at market comparables. And just to break this, break this into multiple parts. If you look at seed to Series A, the business risk is very, very high, but the valuation risks are lower because your entry pricing is typically very low. Series B to Series D, typically we see the business and the valuation risks are very high because the company is still not fully in the growth stage. They need liquidity to go out, grow, and take it to the next level. Series D onwards, what happens is the businesses have stabilized. If you reach Series D, businesses have stabilized, but there's always a fear that you might really overpay for a very, very good company. I think that's where we come in. We spend a lot of time to understand, where these companies are, going to go IPO. That is one. Two, there are most of these companies will have some public comparable. If not, obviously, we'll work with them to understand that what will be the 2-year forward projected earnings, what could be the multiple which we will probably get, what's the discounting we are seeing today. And also what we are noticing is that if a company is out in the market to go out and raise a pre-IPO scenario, I think we'll probably duck that situation, but we'll come back to you with a lot of secondaries at that point, which typically will make sure that we are at least 1 or 2 years in the money from an IRR perspective. So I think those bets will become really outlier for us to do, because I think the business is fine. We are just perfecting the valuation entry point. As an institution, we don't believe in FOMOs. If somebody is saying that now or never, I think we are okay not going to all the parties in town. Divyansh, next.
Yeah, while we are waiting for the next questions, just because we have a lot of investors here, I would also love to introduce Pallavi. So Pallavi has joined us to lead sales and deal management at Let's Venture. And, she is your interface. I mean, she is the one who's actually worked very tirelessly to get everybody on this webinar along with Divyansh. But Pallavi, maybe if you want to introduce yourself quickly.
Thanks, Shanti. Hi, everyone. Possibly, I might have interacted with few of you in past couple of months. So I'm coming with 16 plus of years experience in sales and marketing. I have started my career with the telecom industry from Airtel, been a part of VC industry for more than 6 years now. So this is my short and sweet intro. And in coming days, I will be interacting more with each one of you.
Thanks. Do you want to talk about what are the kind of transactions you're seeing, or any comment on this entire webinar, Pallavi? Please feel free to add to our conversation.
I will. So this was a much needed webinar, honestly, and that's how we thought through bringing it up with the market sentiments changing and India becoming the towards Atmanirbhar India. Right? This is the right time to evaluate these startups, and we see a lot of interest coming in from the global investors. Only thing is that I think it's required more education, required more exposure, why to pick this asset class and build a portfolio of multiple sectors. So I think much needed webinar, and investors here, we will be bringing up many more such topics for you in coming days. So stay tuned.
You should close with your LinkedIn post, Pallavi, today. I loved that post. I actually loved it because it was such a good summary of how investors should think of their role when they invest into founders. So I would want you to talk about that post.
Now, Shanti?
Just like a 10-second brief on that.
Yeah. So, many of the times we see startup investing is not only about building a wealth. It's not only about creating a wealth. It's about uplifting a vision. It's giving wings to the vision. It's actually creating a lot of employment also in the country. And, founders coming with the vision. Nobody thought when anything started in a garage can become a big organization. So trusting the founders at the early stage, helping them at the early stage. So every win the founder experience, it is actually the win of the investor who betted on them at the early stage. So I'll just summarize quickly with my post which Shanti mentioned. So it was a beautiful quote from an unknown, which really caught my attention, which said, I helped a man climb a mountain and found that I too reached the top. So you can just relate it with the founders and the investors, because when you back a passionate founder, you are just not funding an idea. You are actually investing in their climb.
Absolutely.
Yes, yes.
Thanks for that.
Yeah. Thank you, Pallavi.
Do we have any more questions, or I can move ahead?
We do have questions, Pranav, but I think we had a good break.
I think India also, has a lot of angel talent, and we can proudly say that some of the smartest investors, and the longest investors in the angel ecosystem are a part of the LBX ecosystem today. Anupam Mittal, Vivek Khare, Nipun Goel, these are masters of the trade. They have been around for a very, very long time. They have been our ardent supporters. And we always say that, if a deal is suppose not doing well on Let's Venture, it will never do well. And I think it's not because of us. I think it's because of the investors who are supporting the cause. And I think that's our learning, and that's their learning. Many of them will have hundreds of companies in their portfolio, decades of investing in India, and I think that really helps us to really bring the quality of the deals which we're getting to the table. And obviously, they give a tough time to Pallavi, and they extract the best from our team. So we are building this portfolio, and I'll not call it a fund. We'll not call it a fund. We'll call it a portfolio approach to investing. We have shied away from a fund for a very long time, but I think some of our global investors are really pushing us for that. What we are saying is we want to invest across consumer brands, fintech, healthcare, biotech, B2B, manufacturing, logitech, and deep tech. And the reason and the key theme is across sector, across stages. The details of it we'll share later. I think how the portfolio will look like. I think, and we have picked up companies from our own portfolio just to see that how at various stages we come in to select companies which we think are either breaking out or they're broken out. And I think that reduces significantly the element of risk and probably gives us a far more leverage on the upside. So if you look at, this is Let's Venture's own portfolio. If you look at consumer companies, we could have GoStocks, Leverage, Seco, Deep Tech. We are one of the largest investors in Agnikul today. We have Redcliffe, we have Ultraviolet today, Batex, which is a very famous drone company. Obviously, Jiva, Samosa Party, XYXX, Mohan, need no introduction. And these companies, all of these companies were working with us at various stages of their life cycle. In Samosa Party, we have done 3 rounds. Jiva was discovered by Shanti very, very early. XYXX, we did 3 rounds with them. What we are realizing is that some of these companies, some of these sectors are showing certain entry point. At that point, it becomes the safest for us to invest. And I think that is very, very critical. But if you look at the other end, if you look at companies like ePlane, Agnikul, when these companies came in, they were probably, 2 people a deck, and for IIT Madras, that's about it. But when we looked at them and we spent time, we built consensus with scientists, we built consensus with fellow investors, we co-invested with some of the finest investors. I think that's the time when we see maximum expansion happen. So our strong belief is that instead of just allowing and still the power law will work out in some of these companies, like Agnikul has given us a 50x sort of a return. Our IRR will be nearly 100% nearly today, because obviously some of the companies will really break out. But instead of saying that out of the 10, 15 companies which we are working out, 2 of them will do well, we are okay for the others to die. We don't want the others to die. What we're trying to do is perfect the entry point across sectors and across stages. And I think this is a sort of a model portfolio, and which is actually possible to build. And some of these companies, we can still go out, acquire secondaries, primaries, be a part of it. And because Let's Venture has been early with many of these journeys, we obviously are having a ringside view with nearly 900 companies, what's happening in the country. So I think this is the new era of, this is like the mutual fund creation of the VC world or the startup investing world, because we believe in capital protection, and obviously some of them will really break out. This also gives us a chance to keep looking at companies or technologies which will really become disruptive. So we can write a small check, wait for them to grow, but even if they don't do well, in our larger scheme of things, we'll be quite okay. Plus, each one of them had a very large domestic or global investor whom we were co-investing with. So I think that is the defining part, because not only us, but also some of the other global investors, some of the large Indian investors are investing. And again, we'll probably never overpay for an asset. We'll come to a point that yes, it's in striking distance, and we will make some good money. I think that's what it is. I'll pause here. If you have any questions on the fund, or if you have a question on portfolio construction, or how some of our smartest investors are investing, building portfolios, happy to answer.
Yeah, Pranav. There is a question for 2 to 3x return potential on 4 to 6 year horizon.
Yeah.
Isn't it too risky? Careful portfolio building through stocks or even EMS can generate these returns.
So I think it's I'll again go back to that the table which we are seeing of capital allocation. I think it's a function of capital allocation. If you are, and also, I think we are in an upcycle for the market, but if you just go back to 30, 40, 50 years of market history, you will see that there were probably years when nothing happened in the stock market. And at that time, when people go out and they just forget about it, and that's the reason this whole SIP, the whole SIP ecosystem, what has created, I think it's important for us to keep building at that point of time. We'll also, I think if you just keep a look at the IPO market also, and the reason I moved from public markets to private markets was a very strong conviction for the next 400, 500 companies, breakout technologies will come from the startup ecosystem. And I think that if that conviction is what you're playing with, we would really encourage that you invest, say, 4, 5, 7% in the startup ecosystem, build it over a period of 2-3 years so that you're not selling your house and putting all your money in. But I think it's an important asset class, which you should not miss out.
Sounds good, Pranav. One question, then we can proceed. We will take the rest later.
Sure.
For a new beginner in startup investing, basically how one can learn to pick up the right startup. If you can break it down into step-by-step process from your experience.
So I think if you're a beginner, let's assume this is the first time you're listening about startup investing. I would encourage, one is obviously get onto the LVX platform and just see the deals. I'll take you through the platform. It's very easy. It's fully online. You can see it from wherever you are in the world. I think it's just important that you just start skimming through the deals which we are going through. Every week, there's a deal launch. On Friday, there's a founder call. You should come onto the call, ask whatever questions you have, ask the team about the deal structure. And I would really suggest start small. Write a 5 lakh, 10 lakh rupee check to start with. If that's the minimum what you could do, and then just see how the portfolio builds. So I think one thing which I missed out is in the fund also, 50% of the fund will be for follow-on. So, if certain companies are breaking out, it's important that you go and you double down on that. Because that will give you the power law effect. So I think be a part of the LVX community in your city, or it is in your country. We are having an active community pool which is there. Be a part of our events. Just talk to startups, and more. I think the learning will actually come only when you probably see more deals, and you can't learn to swim until you don't jump into the pool. I think it's important. I think from a portfolio perspective, talk to Pallavi. She'll help you to construct a portfolio, where we think that, you need some deep tech, some fintech, some consumer brands, and Pallavi and her team will really help you to build that portfolio. All the deals are curated, all the deals are led by either a VC or a large family office. So the element of risk is significantly lesser when you're investing.
Thanks, Pranav. We can proceed. There are more questions. We'll take it up after 5 minutes.
I think, this is the leadership of Shanti, me, Pallavi, Pramod, who heads our partnership. So I think these are the 4 pillars of LVX today. And obviously, we have a very, very strong team, pan-India, across 7 cities who are out there to work with you guys. Just give me 2 minutes.
Sure.
Shanti, would you like to add something? Shanti, Pallavi?
No, I'm good. I think you've covered most of the points, Pranav. I think just one point which I'd like to talk for new angel investors is that, like what Pranav said, I think start small with smaller checks, meet more founders before you write your first check, and engage a little bit more deeply, because you have to treat this as a asset class which you need to understand a little better. But I think the more you meet founders, the more investors, and the more kind of conversations you have, I think it becomes much more easier. But Pallavi, I think you should add, you have a pretty detailed pitch for new investors. I think you should add to this.
I think to start with, start with the category which you're more comfortable with and can relate to start with. However, don't just stick to it, because in the startup investing, the building of the portfolio is extremely important. Picking up multiple sectors, because I talk to a lot of people, and especially the people coming from the tech background, they just want to invest in the technology, which is good. But at the same time, it is also important to invest into fast moving sectors, different sectors. It's like, and that's how LVX philosophy is. We bet on great founders, good businesses. So just come on our pitches, pitch calls. I believe the pitch calls themselves are extremely educational pitch calls, because for one person to evaluate business from every angle might not be possible. But on any given pitch call, you will find more than 70 plus serious investors. And the format which we have created is after the introduction and the evaluation from the founders and then the in-house view, the floor is open. You ask as many questions as you want, and we will ensure to give you all the answers. So it helps you to take a more informed risk-taking decision to invest in a startup, because a lawyer is asking legal questions which a tech person might not be able to understand. So that's how come on the pitch calls. And another request which I'll just put across to my investors is talk to your relationship managers, right? These are well-trained guys. Unlike on any other platforms, LVX RMs are very well trained on the startups coming on the platform. They can give you the directions. You can ask in-depth questions from them. If they can't, they will get you the answers. But talk to them, discuss with them. We don't create any FOMO. We don't work in that culture. We will give you ample of time to evaluate and take an informed decision. So just work along with us, and we will help you, guide you step by step to take more informed decision.
Cool. Thanks, Pallavi. So this is the last leg. I think you guys can see my screen. There's a simple login. You can just go to our website, create an account, just log in. And this is a live deal, as you know, which you can see, which is right here. This is India-US corridor deal, sending Asian food, groceries. You can see the deck, which is here. Somebody can just scroll through it. You can see it on your phone. You can see it on your desktop. It will not be a problem. The deal details are given on the right side of yours. It's the detailed pitch video, team, product summary, transaction history. And it is very exciting. You just go out here, click, and it takes you to your commitment page. Certain consents are there. And that's about it. You can pay out there and you can move on. And if you need any help, if you need more data, you can always reach out to your RM. The RM can connect you with the founder or get you that information. I think the tech interface is very critical, because it helps you to real time see information wherever you are in the world. It remains over here for a long period of time, so you can educate yourself. And I would always say that even if you're not investing in a particular startup, please ask those questions, because I think that's the differentiator. There's a portfolio, you can see your commitment status, deal which you're interested. You won't just probably just say like it. It's like a Netflix movie, just say like it, I'll probably see it later. So I think these, and then obviously the document vault is out here. All the investments, what you've done, all your documents sit here at one single window. So I think you don't have to practically call up any RM unless you want to talk to them on a particular transaction. And in 24 hours, you typically get a response back from our tech support if there's a problem out there. And you'll always have Pallavi's and my number. If you have a problem, just pick up the phone, chat with us. And I think more you talk to us, I think more the learning curve will come for both of us. We would love to hear your perspective, your sector expertise, what you come to the table. I think that's the most interesting part, because some of our investors, run large businesses, and we always pick their mind on how they're seeing certain sectors, or they're seeing certain green shoots, and I think we build our own learning curve from that perspective. I will pause here. I think we have a few more minutes, and I think then we are good. Divyansh, any more questions? Sorry, you're on mute, Divyansh, if you're talking.
Pranav, we have a couple of questions.
Yeah.
So the first question is, yes, the first question is, if the market isn't well understood, what are some of the specific questions you can ask a founder to test their depth and operational capability before making a decision?
I think that's a very interesting question. One of the filtering criterias I have is that most of the times we are backing founders who have spent some time in that space. These are not idea stage companies at all. These are not pre-seed, seed. We don't do that anymore, because we have realized over a period of time that the risk perception is higher. Except extreme deep tech companies, most companies will have revenues, will have monthly MRR tracking sheets, which will be there. They will be burned. They will be understanding of hand. They'll have a next 2-year projection. So I think they would have come off from a product market fit, a clear strategy for GTM, and we will start seeing a clear uptrend what is happening. If those trends are not there, we will probably sit out, keep following those companies, and come back to invest in them in the next round. Because I think typically people make 4 mistakes in the startup investing. One, investing in founders who are not technically qualified to look at it. Number 2 is you sometimes overpay for that. Number 3 is inherently the businesses don't make economic sense. And 4th, and the most valuable, is not taking money off the table when you get an opportunity for an exit.
Makes sense. One question, Pranav, that how often does a compelling startup cause you to rethink and adapt your investment thesis? If it has happened in the past, can you give an example? How did you go about it?
Sorry, can you just come back to me on that question?
Yeah. So the question is, how often does a compelling startup cause you to rethink and adapt your core investment thesis?
Yeah.
And if this has happened in the past, if you can share some example, and how did you go about it?
Absolutely. So I think, unlike most VCs, we don't have a stencil and we are running around trying to find out a drone company, an AI company, and a brand company. We don't do that. We talk to thousands of companies as a strategy. What we are seeing is a few parameters on how the business fundamental is, how the founder is, how the market is, how the unit economics over there. I'll give a simple example. One of our star companies in our portfolio is Samosa Party. When I first spoke to Diksha, who was a founder, and I started wondering that how can you make a big company out of selling samosas? Because the regional business, every city has a very famous samosa guy. When we were talking to her, the annualized run rate was probably a couple of crores. And she convinced me and the team that, and they had very clear ideas. Excellent hub and spoke model, back kitchen, obsessed about the quality of the product, obsessed about how the outlets will look, how is the GTM, and they have come from this field. We did one round of investing, we did second round of investing, we did a third round of investing, and from that 1 crore ARR, in a matter of 3 to 5 years, the company is at 100 crores ARR. So I think our original thesis was, who will eat samosas? So obviously we pivoted, we learned, worked with the founder, built deeper understanding, and we went out and we kept putting in more money behind that company. We're always learning. We're not founders, investors always teach us, happy to learn, happy to understand. We don't have a stencil trying to fit a company in it.
Thanks, Pranav. Pranav, I have one more question. It's an interesting question. We'll take this as the last one.
Yeah.
For somebody who's not a beginner but has already invested in 15 startups and would want to join your platform, how is his or her experience going to be different as compared to other platforms?
I think excellent question. I was waiting for someone to ask. See, most of the platforms are voting machines, right? There's a massive FOMO. Most platforms go out and value their own deals. We're not valuing our deals. We obviously have a view on valuation, but we don't go and value our deals. Two, if you have 15 startups in your portfolio, please tell us, we'll help you to sell them. We spend more than 50% of our time in selling people's portfolio companies. Either we can sell it in our own company, we can sell it to people outside, to VCs, to large family offices to look at it. Three, is also important that every platform in the country has a different genre, different style of investing. And I think, and usually people are a part of more than one firm. I think it doesn't cost much to be a part of it. I think you have to be opportunistic, because see, if you're investing in public market, let's assume you are with Motilal or Zerodha or you are with ICICI Securities, ultimately you're buying Nifty and Reliance and HDFC, right? The end security is same. They are either playing with you on technology, on pricing, or on information. But every startup ecosystem, every startup player, every VC will have a very, very different deal flow. So I think it's better to be diversified, and you obviously have a chance to do direct, you have a chance to do growth deals, you have a chance to do secondary. So we're actually playing all the way in the value chain, right? So we're not specializing only in early stage, or only in growth stage, or only in VCs. And because you have such a large canvas, you have a lot of opportunity to talk to Pallavi, build your understanding, and more importantly, if you want to go out and put money in a particular company and say, I want to put 2 crores in X company, I'm not getting the allocation. We will get it for you, because most founders will know us, or we will know people on those cap tables. So like a concierge, you can just come and tell us, and we'll work with you to help you to get that.
Okay. Thank you, Pranav, for that. Before dropping off, we'll just take one poll to gauge what is really holding back people to start investing, especially in India, and probably we can have a couple of questions from there as well. So the poll is up. We have about 10 seconds to answer it. So if you haven't invested in India yet, what's really holding you back? Okay, so most of the people say that there are no trusted networks partners. Many are thinking they lack market knowledge to invest in India, and the rest are concerned about the risk. So I think the top 2 concerns, Pranav, here is that they are not able to find any trusted network or partner, and second is the lack of market knowledge.
If you've been around for 12 years, I think that's a long time to be around. And so you can definitely trust us. And I think knowledge is probably what you'll build over a period of time. By getting more involved, we encourage you to talk to our team, talk to the founders, be on those calls, ask more questions. I think that's the learning curve will come along. I'm happy to work with you guys, and I'm happy to take your questions offline. If you have questions, please drop us an email and we'll get back to you.